Hello, my name is Robert, and I'd like to welcome you to today's webinar, International Tax Lunch Form 5472 Filing Requirements and Preparation. Please note that this is a webinar, which means audio over PowerPoint only. Per the NASBA and CBA requirements, you will receive 4 attendance checks every hour. The attendance check will pop up over the webinar. Click the OK button to receive credit. Before we begin, there are a few things to note about the webinar platform. To your bottom left, there is a feature called Class Chat. Please feel free to use the Class Chat to talk with other online attendees about the content. The chat is not monitored. To your top right, there is a tab called Ask the Instructor. Please use this tab to ask any content-related questions. We have reserved the last 10 minutes for Q&A if time permits. To the left of the Ask the Instructor tab is a tab called Group Form Only. Please fill out the form if you're viewing with another person so that everyone receives credit. Now let me introduce our speaker. Deborah Rudd is a CPA at Hodgen Law PC, an international tax law firm. She graduated from Columbia University with a Bachelor of Arts degree in philosophy and is now earning an MS degree in taxation. Every day for her means solving complicated cross-border tax issues, whether it's working through the intricacies of expatriation planning and tax compliance, massive cleanup jobs, or PFIC taxation. So let's get started and welcome Deborah Rudd.
Hey everyone, Phil Hodgen here, and welcome fellow humans. We're totally not tax bots. This is the Friday once a month Hodgen Law PC International Tax Lunch. As this happens every Friday, second Friday of the month, noon Pacific time, you can listen online like you're doing now. We put it up later on YouTube, and you can have fun with it. This month we're talking about Form 52 filing requirements and preparation. An important and useful topic because our overlords in Washington, D.C. recently raised the penalties for screwing this up to 25 grand. I will insert rant here, but let's move on. This is all about foreign owners of domestic corporations, foreign corporations engaged in U.S. trade or business, and some domestic disregarded entities owned by foreigners. And for all of these entities, there may be a 5472 filing requirement. What's more fun is that there are actually a bunch of complex attribution rules, as you might guess, that make identification of what you're supposed to report and when difficult. So this one is all about learning when Form 5472 is required, the types of attribution rules you should look at, and major issues to look out for. And our speaker is Deborah Rudd, and I'll turn the mic over to her right now.
Hey everybody. So as Phil mentioned, we're talking about Form 5472 today. Me personally, when I was just starting out as a tax preparer, I would always think, Form 5472, it's so little, it's only 2 pages, how important could it be? Turns out it's extremely important. It's now 3 pages. As Phil mentioned, the penalties have gone up to $25,000 for not filing it or filing it incorrectly. And that's per form each year, so if you have multiple of these, it can really add up. But we'll talk about the penalties and the new changes for 2018 a little bit later. We're going to start at the beginning with when Form 5472 is required. So we'll talk about what the filing criteria are and who has to file it. We'll then talk about the attribution rules that Phil mentioned. Can only go into these in so much depth in the time that we have available. They can get very complex, especially when you have complex structures that you're dealing with. So we'll just look at some simple examples. And then we'll talk about what's new for 2018, increased penalties and other stuff. I'm also going to once again talk about what was new for 2017, and that was the rule where some disregarded entities have to file this form. I'm keeping that in this year because that's still fairly new and fairly important. And then we'll talk about penalties, how those work, how they get applied, what you can do about them if they get applied. And then lastly, we'll take a look where we give a scenario and then walk through preparing a Form 5472. So, talking about when Form 5472 is required. So to file a Form 5472, or to have a Form 5472 requirement, there's three things that have to be true. You have a reportable transaction between a reporting corporation and any U.S. or foreign related party. So you have a reporting corporation, it has a related party, and there's what's called a reportable transaction between the corporation and that related party. We're going to look at what all of those bold words mean. The first one, reportable transaction. This is basically any transaction listed in Part 4 of Form 5472. So you can actually pull open a Form 5472, scroll down to Part 4, it's on the second page, and look through the list of transactions. Those are the reportable transactions. And this is where there was money paid or received, or something that was not money, property of some kind, or something less than full consideration, so something other than fair market value. Anytime you have this reportable transaction between a reporting corporation and related party, the 5472 is required. So just to go down the list very quickly, I've listed all of the transactions that are in Part 4 on these two slides, slides 7 and 8. But the really common ones that I personally see are compensation, loans, interest, because if you have a loan, you have interest, rent, those types of things. I personally deal with corporations that don't necessarily run active operating businesses, a lot of times holding companies for real estate, things like that, so that's why I see those types of transactions. If you do different types of tax returns, then you might see a lot of these other transactions as well. And just to run through the list real quick, sales or purchases of stock and trade, sales or purchases of tangible property, platform contribution transaction payments or receipts, cost-sharing transaction payments or receipts, rents paid and received, royalties paid or received, sales, leases, licenses, purchases of intangible property rights, consideration paid, received for technical, managerial, engineering, construction, scientific, or like services. This is one I see a lot for example, management services and receiving payment for that. Commissions paid or received, amounts borrowed or loaned, interest paid or received, and insurance or reinsurance premiums received or paid. And again, the other ones I mentioned, loans and interest, those often come up in my line of work personally. So those are your list of reportable transactions. Now let's take a look at what it means to be a reporting corporation. There are three types of reporting corporations. The first is a 25% foreign-owned U.S. corporation, and when they say 25% foreign-owned, they mean by value or voting power. Take a look at what that means in just a second. The second type of reporting corporation is a 100% foreign-owned U.S. disregarded entity. And the third type is a foreign corporation that's engaged in a U.S. trade or business. So if a 25% foreign-owned U.S. corporation, that's where one or more direct or indirect 25% foreign shareholders exists at any time during the tax year. And a 25% foreign shareholder is a foreign person, could be an individual, corporation, whatever, who owns directly or indirectly 25% or more of the total value or voting power. So anytime you have a single entity with a 25% or more interest, and it's a foreign entity or person, then you have a reporting corporation. And when you're looking at this 25% foreign ownership, you do actually apply the Section 318 attribution rules, and they give a 10% threshold instead of a 50% for the purposes of applying the attribution under 318A2. We're actually going to go into a little bit more detail on the specific attribution rules later, so if that didn't make any sense, don't worry about it right now. Okay, so moving on to 100% foreign-owned U.S. disregarded entities. This was a new requirement for 2017 and later years. As I mentioned, I'm going to cover that, even though it's not new again for this year, but it's important, and it's still new enough, so I'll be covering that again a little bit later in the presentation as well. But the general idea is whenever you have a domestic disregarded entity that's 100% owned by a foreign person, then that domestic disregarded entity, for the purposes of Form 5471, is treated as an entity separate from its owner and classified as a corporation for the requirements that apply on 5472 to a 25% foreign-owned corporation. So it is in fact a disregarded entity, but for the purposes of 5472, you treat it as a corporation, and all of the requirements that apply to a 25% foreign-owned corporation apply to your domestic disregarded entity. In addition, you also have to report more transactions for the disregarded entity than you would for a corporation. For example, capital contributions and distributions. And there could be other amounts that might be reportable for a disregarded entity as well that are not required for corporations. And then the last type of reporting corporation is a foreign corporation that's engaged in a U.S. trade or business. And when I say foreign corporation, it just means that it's under U.S. tax law, it's classified as a corporation, and it's organized under the laws of a jurisdiction outside the U.S. or in a U.S. state. Those of you who are familiar with looking at these types of things know that what's a corporation under U.S. tax law, it might not necessarily be a corporation under the foreign law where it was formed or operates. So just be on the lookout for that. And when we're talking about engaged in a U.S. trade or business, unfortunately, that's not actually well defined anywhere in the code or regulations. It's more a matter of case law. But the general idea is that you have regular, substantial, and continuous business activities for the production of income, typically from selling goods or providing services. So, in other words, if you have a foreign corporation and it does stuff in the U.S., look at that requirement because it might well have to file a Form 5472. The last requirement for having to file a Form 5472 is that there's a related party. As remember, the corporation has to have a reportable transaction with a related party to have to file this form. Related parties include direct and indirect 25% foreign shareholders of the reporting corporation, any other person related to the reporting corporation by more than 50% ownership, any person who is a more than 50% owner of a 25% foreign shareholder of the reporting corporation, anyone related to the reporting corporation under Section 482, and notably, it's not a corporation filing a consolidated return with the reporting corporation. So these are some pretty specific thresholds and ownership amounts that you have to look at. And when you're looking at the related party, you also apply attribution rules there, which I'll cover again a little bit later. There are, as usual, some small modifications that you make to the attribution rules as well. And note that the related party can be a U.S. person or a foreign person. Even if the related party is a U.S. person, if you meet the other requirements to have to file Form 5472, you do have to file the 5472 to report the transaction with the U.S. related party. You don't report the specific dollar amounts in Part 4 of the transaction, so you don't show what the transactions are, but you still fill out the form and you show that it has a U.S. related party. And of course, shareholders are typically going to be related parties, so just kind of a shortcut to, is there a reportable transaction with the related party? If you're looking at a domestic reporting corporation, 25% foreign shareholders are one of the categories of related parties. Domestic reporting corporations, if they're a reporting corporation, they have a 25% foreign shareholder, so all domestic reporting corporations will have at least one related party. That'll be any of the 25% foreign shareholders. And very often, reportable transactions take place directly with those people or those entities. So that's one quick place to look to see if you have a 5472 requirement. And then lastly, for this section, if you have a reporting corporation and there's a related party, but there's no reportable transaction between them, then there's no Form 5472 required. So there has to be a reportable transaction for you to have a requirement to file the 5472. And that's, I think, the very first one listed in the exceptions to filing on, I think, page 2 or 3 of the form instructions. All right, so moving on to the attribution rules. Here's where it starts to get a little bit more complicated. These matter for two reasons. You use the attribution rules in determining who's an owner of the corporation for purposes of determining whether it's a reporting corporation, and you use it to determine who's a related party for seeing whether a reportable transaction took place between the reporting corporation and a related party. So we apply these rules in two places when we're looking at the Form 5472. The general rule that you use is Section 318, and there's some modifications to how that works. But the general idea is it applies to lineal family, so spouse, children, grandchildren, parents, but not your siblings, not your cousins. Partnerships and estates, it applies proportionally both ways with partners and beneficiaries. I'm going to talk about what I mean by both ways in just a second. Trusts, you apply it both ways with owners and beneficiaries, and corporations both ways with 10% or more value shareholders. Actually, I think that actually might be a slight typo. It's 10% for downward attribution, but 50% for upward attribution, and we'll see that slide in just a second. And there is one exception to the attribution rules as well. There is no ownership attribution of stock to U.S. persons from foreign persons for the purposes of Section 318A3. That's the upward attribution. So here's what I mean when I say both ways. The first one is very easy. This is the one that me personally, I always think of when I think of attribution. So you have person A, let's say it's an individual, owns 100% of corporation B, that's a foreign corporation, and corporation B owns 100% of corporation C. Corporation C is a U.S. corporation. So under the downward attribution rules, person A is attributed ownership of corporation C, and I think this one would be in Section 318A2. The other one, upward attribution, or I'm not sure upward is the right word. I've heard other people use it, and I kind of tend to think of it because it's a good complementary term when you're saying downward. So downward and upward. Upward attribution is a little bit more complicated and a little more counterintuitive. So let's use this example. Person X, a U.S. person, let's say they're an individual, owns 100% of corporation Y, a U.S. corporation, and person X also owns 100% of corporation Z, a foreign corporation. So the way you apply this rule, it says that if 50% or more of the stock of a corporation is owned by or for any person, so we have person X owning 50% or more of corporation Y and 50% or more of corporation Z, then such corporation shall be considered as owning the stock owned by the person. So in this situation, you would say that Corporation Y is considered to own Corporation Z's stock. Corporation Z is considered to own Corporation Y's stock. What we have here is Corporation Z is a foreign corporation, and if it's considered to own the Corporation Y stock, then you have a foreign corporation that owns the U.S. corporation. That makes the U.S. corporation a reporting corporation, even though it's 100% owned by a U.S. person and there's no one else above it in the chain of ownership. So this one can lead to some very counterintuitive results, and when you're working with more complex structures, it gets even worse. Now here's an example just to walk through sort of how you figure out, is it a reporting corporation under the attribution rules. We have a U.S. non-resident at the top. This person owns 50% of a foreign corporation. That foreign corporation owns 100% of a U.S. corporation. The U.S. corporation is going to be a reporting corporation because, first of all, the foreign corporation is a 25% foreign shareholder of the U.S. corporation, but also because the non-resident alien at the top is a 25% foreign shareholder of the U.S. corporation under the attribution rules. So there's two 25% foreign shareholders for this U.S. corporation. And then if you apply the related party rules, both the foreign corporation and the non-resident are considered to be related parties. So if this U.S. corporation has any reportable transactions with either the foreign corporation or the non-resident who owns the foreign corporation, then this U.S. corporation has to file the 5472. So another example, let's say that you have a U.S. non-resident. They own 25% of a foreign partnership, and that foreign partnership owns 50% of a U.S. corporation. Again, the U.S. corporation is going to be a reporting corporation because the foreign partnership is a 25% foreign shareholder of the U.S. corporation. The non-resident alien is not a 25% foreign shareholder because if you multiply the share percentages there, you get less than 25%. But there is a reporting corporation here because of the foreign partnership. Now, interestingly, when I look at the related party rules for this, obviously the foreign partnership is going to be a related party because related parties include 25% foreign shareholders. But looking at the non-resident at the top, when I look at the related party rules, I think that person is actually technically not a related party. It's not a 25% direct or indirect foreign shareholder. It's not related to the reporting corporation by more than 50% ownership. It's not a more than 50% owner of a 25% foreign shareholder. So when I go down the list, I actually don't see where that person at the top is a related party. Of course, there is the related party with the foreign partnership, so if there's reportable transactions, the 5472 needs to be filed. But what I wanted to illustrate with this is that when you're looking at all of these rules, it's really important to kind of go through each and every step in figuring out if you have the requirement, because yes or no can kind of turn on a very small detail like this. So that's sort of an overview of the attribution rules. Obviously, if we had more time, we could go into a lot more detail and talk about those for easily a full hour or two. But this is really intended to be more of a general overview. So let's talk about what's new for 2018. First of all, as Phil mentioned at the beginning, there is increased penalties, and there's also additional information reporting that was added to the form. Previously, if you didn't file the 5472, you would get a $10,000 penalty. It's now $25,000, starting in 2018 and for subsequent years. And when I say in 2018, what I mean is for the 2018 forms that we're now filing in 2019. There are also some new information reporting requirements. All of them are related to the new tax laws that passed at the end of 2017. The first is in relation to the BEAT tax under Section 59A. There's some questions in Part 8. You only have to fill those out if you have to pay that tax, but those are there on the 5472, and I would assume if you omit any of this information when you are supposed to fill it out, that could create a situation where you have an incomplete 5472, potentially subjecting you to penalties. So the IRS is really looking for all these different parts to be tied together between your 5472 and your corporation return. The other one, the foreign-derived intangible income under Section 250, there's questions in Part 7 related to that, and as we'll see later, all reporting corporations have to fill out Part 7, and you have to affirmatively say yes or no to those questions. And then the new rules for disallowed interest under Section 267A, there are also some questions for those in Part 7. Lastly, the IRS, they added one box on Part 3 of the form. You have to provide a foreign tax ID of a related party if one exists. So kind of a small detail on that one. Now let's talk for a minute about the rules that were new for the 2017 forms, the ones that we were all getting used to a year ago. I want to talk about this again because it was kind of a major change for the reporting requirements. It's still relatively new for most of us, and it's pretty important. So when you're figuring out, does this apply to you? This applies to domestic disregarded entities that are 100% owned by a foreign person. And when you have a domestic disregarded entity that's 100% owned by a foreign person, that disregarded entity is treated as an entity separate from its owner and classified as a corporation just for the requirements that apply to 25% foreign-owned corporations. So only for the purposes of Form 5472, this law does not extend to otherwise make disregarded entities taxable as corporations. To meet the new requirements, me personally, my first question was, how do I file a 5472 for a disregarded entity? Because a disregarded entity, if it's a single member LLC, for example, isn't going to have to file a federal tax return. So how do I attach a 5472 to a federal tax return? So this is what you do. You provide a foreign tax ID number for the foreign owner of the disregarded entity. You list the Part 4 transactions with the disregarded entity in Part 4. There is a new Part 5 starting in 2017 where you disclose any transaction listed in Part 4 for a foreign-owned disregarded entity. And as I mentioned earlier, there are additional requirements for disregarded entities that do not exist for corporations. So you have to include amounts paid or received in connection with formation, dissolution, acquisition, and disposition of the entity, and also contributions and distributions from the entity have to be reported when you have the disregarded entity. Not the case for corporations. You have to create your own attachment if you have any of those transactions that have to be reported in addition to the same transactions that are reportable for corporations. So there's a Part 5, you check a box, and then you create your own attachment and you put it onto the end of the form. And just to specify, go into a little bit more detail about what types of transactions have to be reported with disregarded entities, there is a regulation that they use to describe these. Transaction for this purpose means any sale, assignment, lease, license, loan, advance, contribution, any other transfer of any interest in or a right to use any property or money, however such transaction is effected and whether or not the terms of such transaction are formally documented. Transaction also includes the performance of any services for the benefit of or on behalf of another taxpayer. So they're really looking to be all-inclusive here. Anything that might fit into this definition of transaction, they want it to be reported for disregarded entities. And going back to what I was saying before about how do you actually file this, because if you have a single member LLC, it doesn't have a federal tax return requirement. You actually have to file a Form 1120 specifically for that disregarded entity. You use the employer identification number that you already have for that disregarded entity. You don't need to get a new one. You fill out just items B and E on page 1 and the name and address of the foreign-owned disregarded entity. You write the words foreign-owned USDE across the top, attach the completed 5472, and you cannot e-file this. You have to send it by fax or by mail to an IRS address in Kentucky, and those addresses are given in the instructions. So if you go into your tax software and try and e-file this, it would not work, I don't think. Okay, so moving on to penalties. This was part of my presentation before they even changed the penalty amounts, because even in the past when it was only $10,000, it's a little bit complicated, and there's a few things you need to know about how the penalties work and how they get assessed. So first thing, penalties have increased from $10,000 to $25,000. That $25,000 is assessed for failure to file, filing late, or filing a substantially incomplete form. Substantially complete, substantially incomplete, I don't think that's actually defined anywhere, but probably most of us have a sort of gut feeling about what that means, filing it to the absolute best of your ability in general terms, but how to interpret that, of course, there's always a little gray area. But in any case, with a $25,000 penalty, it's not something you want to mess around with. There's a $25,000 penalty for failure to maintain records under Regulation 1.6038 Cap A-3. That is separate and apart from the requirement to actually file the form. And I believe that if you fail both requirements, you could get 2 separate $25,000 penalties. Haven't personally seen it happen, but it seems logically possible. There is also, as is the case with most information returns, another penalty for continued failure to file for each 30-day period after the IRS notification plus 90 days. So IRS notification, 90 days passes, and then starting at that point, each time another 30 days passes, another $25,000 penalty gets assessed. And then lastly, for a consolidated Form 5472, there's a separate $25,000 penalty for each group member of the corporation, and each member is jointly and severally liable. So looking at this slide and the last slide, these $25,000 penalties can very easily add up quite quickly. For people who use disregarded entities or U.S. corporations as holding companies for small assets or, piece of real estate, things like that, these penalties are very, very, very high relative to the asset value or what they might be doing in the U.S. Obviously, for when you're talking about giant corporations that have entities all over the world, that might not be the case. This might be very small. So They don't really look at scale when assigning these penalties. If you meet the requirements and you fail to file or file late, you get the penalty, and it's the same penalty regardless of how big you are or how much your assets are worth. And then lastly, very lastly, there are some possible criminal penalties under Section 7203, 7206, 7207. I'm not going to go into detail about those, but just mentioning that they exist because they are pretty, they mention that pretty clearly in the form instructions. If you get a penalty, if you don't file a tax return at all, you might not get a penalty, but of course you have the penalty risk. But if you file late, you can expect an automatic assessment. They will just send you a notice saying, hey, you owe a penalty, pay it. You might be able to request reasonable cause relief if the facts and circumstances support that, and also the first time abate procedures may work. I personally have had that work once or twice. So there are some remedies, but if you're having a continued failure to file more than just once, reasonable cause probably isn't going to work there. First time abate definitely won't. So you really only get to make the mistake at most one time. Now, let's move on to preparing a Form 5472. And in this section, I'm going to show all the parts of the 5472. So we'll go through all the details of what it's going to look like once you've actually filled it out. And we'll start with a scenario. Let's say we have two people, Sue and Joe. Sue and Joe are married and they live in the UK. Sue is a US citizen, Joe is a UK citizen. And Sue happens to be the 100% shareholder of a US corporation, and Joe provides management services to that corporation, and the company pays him for those services. So the very first step is we have a US corporation, and we need to know, does the US corporation need to file Form 5472? So, going back to the beginning of the presentation, there's three criteria we look at. Is it a reporting corporation? Is there a transaction with a related party? And is the transaction a reportable transaction? So, is it a reporting corporation? The company is 100% owned by Sue, who's a US citizen. We look at the attribution rules because clearly it's not foreign owned when we looked at the direct ownership. But under Section 318A1, Sue's ownership is attributed to her spouse, Joe. Joe is a non-resident alien of the US. Joe is attributed 100% of the company's stock. So Joe is, for 5472 purposes, a 25% foreign shareholder. So the answer to that first question is yes, it's a reporting corporation. Second question, is there a transaction with a related party? So Joe is a 25% foreign shareholder. Related parties include 25% foreign shareholders. Joe was paid compensation for management services, and that is a transaction, so yes, there was a transaction with a related party. So we've met 2 out of the 3 requirements so far. Lastly, is it a reportable transaction? And this one's pretty easy. Compensation for management services paid to a related party is reportable on line 20 of Part 4 of Form 5471, so yes, we have a reportable transaction. We answered yes to all 3 questions. So we have to file Form 5472. We have a reporting corporation. It has a reportable transaction with a related party. So here we have the Form 5472, and this is just the Part 1 where you fill out the U.S. corporation information. In the upper right, you put in the total assets of the company, principal business activity code, all the normal stuff. And then on line 1F, that's where you report all the amounts, all the transactions that are reported on this Form 5472. And so they assume that for any given reporting corporation, you might be filing multiple 5472s, and that's why on the next box over, 1G, it asks for the total number of Forms 5472 filed for the tax year, and then it asks for the total value of all the payments made or received reported on all the 5472s. In this case, we're going to keep it pretty simple, and we're using just this one transaction. So we're going to say that Joe was paid $100,000, and we're reporting that one transaction on this one 5472. There's no other reportable transactions, so the total payments reported on all the 5472s is $100,000. We don't check the box for a consolidated filing. We don't check the box for initial year. I'm just assuming that this has been the arrangement for a while, so they probably filed a 5472 in the past. We're talking about a U.S. corporation. It was incorporated in the U.S., files an income tax return in the U.S., and conducts its activities in the U.S. Line 2, this is where it asks if at any time during the tax year any foreign person owned directly or indirectly at least 50% of the total voting power of all the classes of stock, or total value of all the classes of stock of the reporting corporation. Oh, sorry. The first one is total voting power, second is total value. I think I confused those when I was talking. So in this case, we're going to check the box for this because we have Joe, who's attributed the foreign ownership, and he's attributed 100% of all the stock, so by value and vote, that would apply to him. Line 3, this is where it doesn't apply to our example, but this applies to the new law for 2017. This is where you check if the reporting corporation is a foreign-owned domestic disregarded entity treated as a corporation for purposes of Section 6038A. So if you're reporting for a disregarded entity, you would check that box. Okay, so moving on to part 2 of the form. Each line is actually 3 lines. So line 1A through 1E is the first 3 lines here. And those two are asking, lines 1 and 2, those two are asking for direct 25% foreign shareholders. Lines 3 and 4 are asking for ultimate indirect 25% foreign shareholders. And so these can be a little bit confusing. They talk about it a little bit more in the form instructions, but basically the ultimate indirect 25% foreign shareholder is the last foreign shareholder in the chain, and their ownership cannot be attributed to anyone else. So that's where I put Joe in this example form, because beyond him, there's no foreign person to whom the ownership of this company can be attributed. So made up some information for Joe, name, address, put in his foreign tax ID, and he's a UK citizenship, or he's a UK citizen, so we put that information on 3D. And for where business is conducted, I'm never sure how to fill this out for individuals, but I assume that's where they live and work, so I just put that there. Moving on to part 3. This is where you identify related parties for the 5472. And the top line says, check applicable box is the related party a foreign person or a U.S. person. So this is the box that's going to determine whether you actually put specific information in part 4 or not. So if you're checking the box for a U.S. person, you put in their information here in part 3. You don't have to list the actual transactions in part 4. You do, of course, have to fill out the questionnaire sections later in the form, but in terms of reporting the so-called reportable transactions, your work mostly stops here. So once again, you put in the name and address of the related party. If they're a U.S. person, you would be putting in their Social Security number, EIN, tax ID number of whatever kind you have. Reference ID number, this is a number that you assign and use consistently for this person. And then this last one here on the line 1B, line 1B3, this is the new box for 2018 for the foreign tax ID of the related party. So if the related party is foreign, starting in 2018, this box started to exist and you have to put in the foreign tax ID number. Principal business activity, he performs management services, so we put management, put the activity code, and then line 1E shows the relationship to the reporting corporation. So the choices are related to reporting corporation, related to 25% foreign shareholder, or 25% foreign shareholder. So I checked two boxes here because, first of all, Joe is attributed the ownership from a U.S. citizen, so he's a 25% foreign shareholder. That's why this is a reporting corporation. So I checked the box for 25% foreign shareholder. That's the third box. I also checked the box for related to reporting corporation because as a 25% foreign shareholder, he is a related party for the reporting corporation. So we have two boxes here. He's both related to the reporting corporation and he's a 25% foreign shareholder. And then principal countries where business conducted UK, that's where he lives and works, and where he files an income tax return as a resident, also UK. Part 4. So earlier in the presentation I mentioned if you have a reportable transaction, it's going to be listed here in this list. Not the case for disregarded entities, but if you have a corporation, this is the list you look at. And for our example, this is a very, very simple example of a 5472. We have one reportable transaction, and that's consideration paid for management services. So that goes on line 20. And just to point out, you can see how the Part 4 is kind of separated with that line through the middle. That line is the dividing line. On the top, you report amounts that the reporting corporation received. On the bottom, you're reporting amounts that the reporting corporation paid. So you're looking at both sides of the related party transactions. Parts 5 and 6. In this particular example, we're not filling anything out, but I just wanted to include them so that we're showing the full form here. And to point out, Part 5 here, this is reportable transactions of a reporting corporation that is a foreign-owned disregarded entity. Kind of a weird sentence to say. It's a corporation that's a disregarded entity, but it kind of makes its own weird sense within the logic of 5472. So if you have a disregarded entity and it has any reportable transactions from this regulation section 1.482-1I7, other than the amounts that would have been reported in Part 4, then you check this box and you create an attachment and you list these other types of transactions that are required to be reported. Part 6. And this is a part that's been around for a while. This was not new in 2017 or 2018. This is where, again, you have to create a statement if you have non-monetary transactions or less than full consideration transactions between the reporting corporation and a foreign related party. So two little lines here to check. in case you might need to create an attachment and show some additional information. Part 7. Now, this used to be much smaller. It's now Part 7 and Part 8. It's a third page of the form. It used to be just 2 pages. So this all changed for 2018, became much bigger. Note that in Part 7 it says that all reporting corporations must complete Part 7. So everyone has to go through and answer these questions. And I assume when they say all reporting corporations, that includes the disregarded entities as well. So questions, let's see. Questions 1 through 4, I think, are pretty much the same as they were in previous years. Might be some slight changes, but overall those are basically the same. It's questions 5 and 6 that were added in the 2018 version of the form. Question 5 is asking for information about deductions disallowed under Section 267A. And then question 6 is asking about foreign-derived intangible income deductions, so under Section 250. So those are new sections of the tax law starting in 2018, and these parts of the form ask about those specific new items of tax law. So if you have those on your 1120, you would also have to mention those here where you fill them out on the 5472. And then lastly, Part 8. This is asking about the base erosion tax, the new Section 59A. And this section only needs to be filled out if you have those amounts on your tax return. So Part 7 filled out by everybody, Part 8 only if this applies to you. So in this example, I've left these blank. So that marks the end of the 5472. One or two of these, there's actually a specific information reporting requirement built into the law, and the 5472 satisfies that requirement. Don't remember if there's a separate penalty for not meeting that requirement, but there might be. If anyone knows the answer to that, feel free to pop it into the questions or send me an email. But I think it might be possible to have penalties in excess of $25,000 if you have that specific requirement as well. And then I said this is the end of the 5472, but actually I was wrong. When you have attributed ownership, they ask for a statement. This is something from the form instructions. So this is another create your own statement attachment. And so here on slide 53, this is just something that we would attach. Typically we would just use our tax software, but because this is sort of just for this presentation, I just made this in Word. So it basically just explains this guy, he's a non-resident alien, he's the spouse of a U.S. citizen, attribution of rules apply in this way, so this person is the indirect 25% foreign shareholder. So this just basically explains how this person, or why this person, is reported as the ultimate indirect 25% foreign shareholder on lines 3A through 3E. All right, so that pretty much brings us to the end. I think I have time for a few questions, but just to summarize real quick, we covered when the Form 5472 is required, who has to file it, and what you have to report on it. We covered some basics about the attribution rules. As I mentioned, those can get a lot more complicated, but hopefully what I covered today was a helpful introduction. I would definitely recommend when you're looking at those, pull up the form instructions for Form 5472, pull up the actual text of Section 318, read through both of them, look at the instructions which tell you how to modify the rules for Section 318. Get an org chart for the company you're working with. You'll possibly have to even ask additional questions, because a lot of times if there's something in a structure that doesn't really seem important, someone might not tell you about it. I personally have had that situation where I've looked at financials for a company in a structure and found out that it had 100% subsidiary that just wasn't on the diagrams we were given. So always important to kind of do your own diligence and look through everything and really make sure you have a full picture of everything, because between the attribution rules for ownership and for related party rules and the new $25,000 penalty, you can really get yourself into a lot of trouble if you're not starting with the full picture and all the facts of the situation. So that's just my little rant. We also covered what was new for 2018, increased penalties, other information reporting requirements. We covered again what was new for 2017, the disregarded entities rules, a little bit in depth about penalties, how you apply them, how you can get away from having to pay penalties, and then lastly we looked at a slightly more in-depth does this person have to file, and how you fill out the 5472. So thanks for listening. In a second I'm going to go look at questions, but if for any reason I didn't get to your question, or you think of something later that you want to ask or mention, or something I wasn't sure about the answer to, my email address is here on the last page. So thanks everybody. Questions time. Okay, so I might be doing those in reverse order because I'm not sure exactly when they came in, but I'm going to start at the top of my list. And the first one I have is, if a U.S. person owns 25% of a domestic corporation, and at the same time, the U.S. person also owns 100% of a company in China and files 5471 every year on 1040, is the 5472 required? So this is a question about the upward attribution rules, the more complicated one, the one that it's hard to do off the top of your head, in my opinion. So in this situation, you have an individual who owns both a foreign company and a domestic company, and in that situation, let's see, you would attribute the ownership, but only where there's more than 50%, I believe, because you don't use the 10% modification rule for Section 318 A3, where the upward attribution is. So that means that we have a foreign corporation they own 100% of, and that 100% foreign corporation would, I believe, be deemed to own the 25% of the domestic corporation. I might be wrong about that, but I think that the 5472 would be required in that case. Definitely, in any case, it's worth a second look to confirm whether I'm right or wrong, but I think the answer is yes. Okay. Next question, any examples on Part 6 non-monetary transactions? So this is anything that's not cash. So if you're paid in property for something, let's say that someone performs services and receives stock in exchange. That would be non-monetary transaction. So that could be a reportable transaction, even though cash doesn't change hands. All right, so the next question, is there a difference if Joe and Sue live in the U.S. in a community property state? This one makes my brain explode. I do not know. I am not sure how that would modify this, if at all. Very good question. I'm sorry I don't have the answer. Okay, what about the delinquent international information return submission procedures as relief? If corporations are eligible to use that, I don't see why not. I'm not sure if that's something that applies to corporations or if it's only available to individuals off the top of my head. Good question, though. Might work. Worth looking at. I think we're at 1 o'clock. Robert, are we out of time?
Yes, we are, I'm afraid.
Okay. Okay. All right. Well, the other ones, if I didn't get to your question, go ahead and send me an email. I'll be happy to talk further.
All right. Phil here, and thanks for all of you for attending. Again, send Deborah an email if you have a question that wasn't answered during the Q&A. Next month, April 19, be there aloha, noon Pacific time. It's going to be me talking about Form 2555 and the foreign earned income exclusion. If you're not already on our mailing list, go to hodgen.com/newsletters, sign up. If you are already on the mailing list, tell your friends. Anyway, that is it. Turn it back to Robert for the wrap-up.
Thank you, Phil. And I'd like to thank Deborah Rudd and everyone at Hodgen Law and everyone attending online. Certificates of completion will be available for download within 3 business days. Thank you all for joining and have a terrific day.